Money at Work continuing educational series. Today's installment and today's episode is based and centered around learning how to bank like the banks. Banks are extremely good at building wealth. With your money, we need to learn to bank like the banks. The banking industry has taught you to keep your money separated. What does that mean? It means that the bank has you individualize all your accounts and separate all your money, never combining positive cash accounts with the money that you owe, which is interest-bearing loan accounts. Once you understand how this exactly works, it becomes obvious why the bank is continuing to come out ahead time and time again. In order to understand what is happening, we must have some understanding of some basic banking and money principles. When money goes into a checking or a savings account, that's known as a deposit account. The bank turns around and makes interest on your money in the form of loans to other borrowers. The same event is happening when we ourselves take out a loan and begin paying the bank interest payments. Let's look at two examples and the end result of how the bank builds wealth with our money. Number one, money flow. Based on the amount of money that account holders like you and me have deposited into the bank lends that money out. Let's say it's $5,000 to other borrowers in the form of, let's say in this example, credit cards. While we earn close to 0% on our money that we deposited, the lender earns about 18% interest on those credit cards. That means the lender was able to earn $900 in interest annually based on our money, while once again, we're earning close to zero. Let's take a look at the second example, mortgage structure. Have you ever plugged in a GPS coordinate and looked for the longest possible route to your destination? Of course not. That's the way the mortgage structure and amortization schedule is stacked against us. So let's take a look at the example of a $300,000 mortgage over a 30-year term with an interest rate of 4.5%. Now, just looking at those mortgage terms, 4.5% doesn't seem like it would add up to a lot. However, over the course of this 30-year term, we would pay over $247,000 just in interest payments. That actually represents over 82% of the loan amount that you originally borrowed just in interest. Total purchase price, almost $550,000. So what's the end result of this? By following this simple concept of holding billions of dollars in banking clients' money on one side and then turning around and lending that money back to the same people with interest on the other side, the banking and lending industry has been able to build tremendous wealth. I mean, think about it for a minute. The more that we owe, the more interest they're able to collect, and vice versa. The less we owe, the less interest they collect. So if banks make money based off the total amount that we owe, there is one guaranteed way to reduce the total amount that we owe immediately. So what is the alternative? Well, if instead of following the bank's map of keeping your accounts separate, you could transfer or merge your money into deposit accounts against your loan accounts, literally decreasing the total amount that you owe immediately. By doing this, it would instantly bring down the total amount you owe, which reduces the amount of time and reduces the amount of interest the bank has you scheduled to pay. The less money you owe, the less interest you pay. Follow us on MillionaireMindset.life for more financial planning tips, more mindset tips, stretch your thinking, create your vision, and achieve.